Offshore accounts. Offshore accounts are financial accounts held in foreign countries by individuals or entities, often for purposes such as tax minimization, asset protection, or financial privacy. These accounts can be used for legitimate reasons like international business transactions or investments, but they are also associated with tax evasion and money laundering due to their confidentiality and lower tax rates. Shell companies. Shell companies are legal entities with little to no active business operations or significant assets, often established to facilitate financial transactions or to hold assets without revealing the true owner's identities. They can be exploited for illicit activities such as tax evasion, money laundering, and hiding the origin of funds. Transfer pricing manipulation. Transfer pricing manipulation involves altering the prices of goods or services exchanged between related entities in different jurisdictions to artificially shift profits to low-tax regions and minimize overall tax liabilities. This practice is often employed by multinational corporations to exploit variations in tax rates across countries. Misclassification of income. Misclassification of income occurs when earnings are inaccurately reported or characterized to take advantage of tax loopholes, evade taxes, or reduce reporting obligations. It may involve disguising ordinary income as capital gains or mislabeling wages as investment income. Phony deductions. Phony deductions refer to false or exaggerated expenses claimed on tax returns to reduce taxable income, often through the submission of fabricated receipts or invoices. This fraudulent practice aims to lower tax liabilities and can lead to legal consequences if discovered by tax authorities. Income shifting. Income shifting involves the strategic allocation or movement of income from high-tax jurisdictions to low-tax ones through various legal means, such as transferring intellectual property rights, royalties, or profits between affiliated entities. This practice allows businesses to minimize their tax burdens while remaining compliant with tax laws. Round tripping is a financial maneuver where funds are transferred through a series of transactions to create the illusion of legitimate economic activity or to disguise the source of the funds. It is commonly associated with money laundering and tax evasion schemes, as well as illicit capital flows. Tax havens. Tax havens are jurisdictions with lenient tax laws and regulations that attract individuals and businesses seeking to minimize their tax liabilities by establishing residency, conducting financial transactions, or holding assets there. These jurisdictions offer low or no taxes on income, capital gains, and inheritance, making them attractive for tax avoidance purposes. Underreporting income. Underreporting income involves deliberately not reporting all earned income on tax returns to reduce tax liabilities, which is illegal and punishable by law. This can include unreported cash payments, income from freelance work, or earnings from investments. Thin capitalization. Thin capitalization refers to a situation where a company is financed with a high proportion of debt compared to equity, potentially allowing for tax advantages through interest deductions. However, excessive thin capitalization can raise concerns about financial stability and tax avoidance. Debt parking. Debt parking occurs when a company temporarily transfers debt to another party to manipulate its financial position or to avoid tax liabilities. This practice can involve transferring debt to related entities or third parties to artificially reduce taxable income. Earnings stripping. Earnings stripping involves a multinational corporation reducing its taxable income in high-tax jurisdictions by making deductible interest payments to related entities in low-tax jurisdictions. This strategy exploits differences in tax rates to minimize overall tax liabilities. Use of trusts. The use of trusts involves transferring assets to a legal entity managed by a trustee for the benefit of one or more beneficiaries. Trusts can be used for legitimate purposes such as estate planning and asset protection, but they can also be exploited for tax evasion or hiding assets from creditors. Back-to-back loans. Back-to-back loans involve a series of loans between related parties, often in different jurisdictions, to facilitate tax avoidance or profit sharing. This strategy allows companies to exploit differences in interest rates and tax laws to reduce tax liabilities. Fake charitable donations involve falsely claiming deductions for donations to charitable organizations on tax returns, often through fabricated receipts or inflated valuations of donated items. This fraudulent practice aims to lower taxable income and evade taxes. Dividend stripping. Dividend stripping involves buying shares just before a dividend is paid, collecting the dividend, and then selling the shares shortly afterward. This strategy is used to exploit tax laws that offer favorable treatment for dividends, resulting in tax savings for investors. Double Irish with a Dutch sandwich. The double Irish with a Dutch sandwich is a tax avoidance strategy used by multinational corporations to shift profits to low-tax jurisdictions. It involves creating two Irish subsidiaries, one registered in Ireland for tax purposes and the other in a tax haven, typically the Netherlands. By routing profits through these subsidiaries via royalty payments and intercompany transactions, companies can significantly reduce their overall tax liabilities. Captive insurance companies. Captive insurance companies are subsidiaries established by larger corporations to provide insurance coverage for risks within the parent company or its affiliates. While captive insurance can serve legitimate risk management purposes, they are sometimes used for tax planning and profit sharing by charging inflated premiums to shift profits to low-tax jurisdictions. Misuse of tax credits. Misuse of tax credits involves exploiting tax credit programs for purposes other than their intended use, such as claiming credits for activities that do not qualify or exaggerating expenses to maximize credits. This can result in tax evasion or fraud and may lead to penalties or legal consequences. Hybrid instruments. Hybrid instruments are financial institutions that have characteristics of both debt and equity, allowing companies to exploit differences in tax treatment across jurisdictions. By classifying instruments differently for tax purposes in different jurisdictions, companies can reduce their overall tax liabilities. Step transactions. Step transactions involve a series of related transactions designed to achieve a specific tax outcome that would not be possible through a single transaction. These transactions are often structured to exploit loopholes or inconsistencies in tax laws and regulations. Transfer of intellectual property. The transfer of intellectual property involves moving rights to patents, trademarks, copyrights, or other intangible assets between entities, often for licensing or royalty purposes. This can be used for legitimate business reasons, but is also exploited for tax planning to shift profits to low-tax jurisdictions. Treaty shopping. Treaty shopping involves structuring transactions or establishing entities in a particular jurisdiction to take advantage of favorable tax treaties between countries. This practice allows companies to minimize withholding taxes or exploit other tax benefits provided by tax treaties. Bermuda black hole. The term Bermuda black hole refers to the use of Bermuda as a tax haven where profits are routed through Bermuda-based entities to take advantage of its favorable tax regime. This practice can result in a significant reduction in overall tax liabilities for multinational corporations. Digital goods and services. Digital goods and services refer to intangible products or services that are delivered electronically over the internet or through digital platforms. This includes items such as ebooks, software, digital music, streaming services, and online subscriptions. Due to their intangible nature and ease of distribution, digital goods and services present unique challenges for taxation and regulation. Profit participation loans. Profit participation loans are financial arrangements where a lender provides funding to a borrower in exchange for a share of the borrower's profits rather than traditional interest payments. While these loans can offer flexibility and potential tax advantages, they may also raise concerns about the classification of income and the risk-sharing arrangement between parties. Inflated invoices. Inflated invoices involve billing clients or customers for goods or services at prices higher than their actual value. This practice can be used to inflate revenues and profits, leading to tax evasion, financial fraud, or misrepresentation of company performance. Personal expenses as business costs. Treating personal expenses as business costs involves claiming personal expenditures as deductible business expenses on tax returns. This can include expenses such as meals, travel, entertainment, or home office expenses that are not legitimately related to business activities. This practice is illegal and constitutes tax evasion. Phantom stock. Phantom stock is a form of equity compensation where employees are granted hypothetical shares or units that mirror the value of actual company stock. While phantom stock does not represent actual ownership in the company, it provides employees with a stake in the company's performance and may be subject to tax implications. Round-trip financing. Round-trip financing involves the circular movement of funds through a series of financial transactions, often with the intention of creating the appearance of legitimate business activity or inflating revenues. This practice can be used to deceive investors, creditors, or tax authorities, and may constitute financial fraud. Script dividends. Script dividends are dividends paid to shareholders in the form of additional shares rather than cash. While script dividends can provide companies with flexibility in managing cash flow, they may also have tax implications for shareholders and raise questions about the company's financial health and dividend policy. Non-arm's length transactions. Non-arm's length transactions refer to transactions between related parties, such as family members, affiliates, or entities with common ownership, where the terms and conditions are not set at arm's length or fair market value. These transactions can be used to shift profits, assets, or liabilities between related entities for tax planning or avoidance purposes. Re-invoicing centers. Re-invoicing centers are intermediary entities, often located in low-tax jurisdictions, that facilitate the transfer of goods or services between related parties within a multinational corporation. These centers can be used to manipulate transfer pricing, allowing companies to shift profits to jurisdictions with favorable tax rates. Private annuities. Private annuities are financial arrangements where an individual transfers assets to another party, often a family member or trust, in exchange for periodic payments for a specified period or for life. This can be used as a tax planning tool for estate and wealth transfer purposes. Non-commercial losses. Non-commercial losses occur when expenses exceed income from a business or investment activity that is not considered to be carried on for profit. In tax systems, such losses may not be fully deductible or may be subject to restrictions to prevent abuse. Income sprinkling. Income sprinkling involves distributing income among family members or related entities to take advantage of lower tax rates or tax brackets. This can be achieved through dividends, salaries, or other forms of compensation, and is often used by high-income individuals or business owners to reduce overall tax liabilities. Golden parachutes. Golden parachutes are compensation arrangements that provide substantial financial benefits to executives or key employees in the event of a change in control, such as a merger or acquisition, termination, or retirement. While intended to provide incentives and retain talent, they can be controversial due to their perceived excessive payouts. Deferring capital gains. Deferring capital gains involves delaying the recognition of capital gains by postponing the sale of assets or using tax-deferred investment vehicles such as retirement accounts or like-kind exchanges. This can be used as a tax planning strategy to defer tax liabilities and potentially reduce overall taxes paid. Backdating documents. Backdating documents involves falsely dating documents such as contracts or financial records to make it appear as though they were created or executed on an earlier date. This can be used for various purposes, including tax evasion, fraud, or circumventing legal requirements. Leasebacks. Leasebacks are financial transactions where a company sells an asset, such as real estate or equipment, to a third party and then leases it back from the buyer. This arrangement allows the company to access capital tied up in the asset while retaining its use, often with tax or accounting benefits.